So if inflation stays up, eventually there will become a moment of reckoning. And I think the way I've described it for people on my site is Hemingway's old adage about, how'd you go bankrupt? Well, slowly and then all at once. And I think the recognition in the precious metals, especially after what we've dealt with these last 12 months, the recognition that inflation is not transitory and that sharply negative real interest rates are here to stay, I think that recognition comes slowly and all at once.
This week's specials with Miles Franklin Precious Metal Investments. 1 ounce 2021 silver Britannias for only $3.75 over spot. 2021 silver Austrian Philharmonics for only $3.95 over spot. And 2021 silver Australian Kangaroos for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Elijah, my old friend, it's always good to see you.
Definitely. It's always great to see you as well, Craig. We really appreciate all the insights you share with us. And we really wanted to have you on to get this perspective on what's happening in the precious metal markets. We've seen quite a bit of a pullback. As we record this on Wednesday now, we're seeing a bit of a bounce. Gold around $1,750, silver around $2,350. Your perspective on why we saw such a pullback?
Well, it's been a tough year, hasn't it? Man, oh man. I'm sure everybody feels like I do. You go back to a year ago, and we were soaring along. It seemed like the metals had finally become unshackled. The banks were on their heels and that open interest was staying flat. Positions weren't really changing on the commitment of traders report, and price was soaring. And here we are a year later. Conditions really, on a macro sense, haven't changed much. The yield on the 10-year note has gone from, I guess it's doubled, from 60 basis points up to 130. But as you said, inflation has just taken off from less than 2% to now more than 5%. So you put all that together, and if you'd have told me that back in December or January that we'd be here in August talking about that stuff, I'd have thought, oh man, yeah, my $2,300 price target I gave in January, we'd have blown through that. And instead we haven't. And I think at the end of the day, you can lay this at the feet of a number of things, but I think the market in general, I use that as a broad sense of global investors, whether they're institutional or retail or whatever. I think the market in general actually believes this transitory stuff. Negative real interest rates, meaning your inflation adjusted return on bonds, is about 95% correlated long term with gold, or just real rates in general, I should say. If real rates go positive, meaning that you can earn 4% on a treasury bond, but inflation's 1%, so you're making 3% after inflation, that's fantastic. It makes gold, which doesn't pay a dividend, look pretty unattractive. But when you're negative 3%, as we are now, that makes gold look pretty good. And that's why that correlation is so tight. But it's not working all of a sudden. Even in Europe, the German 10-year Bund has a negative 4% real return at present. So why is nobody buying gold? Well, I guess you could say maybe some Europeans are, but why are nobody buying gold futures? And I think in the end, it's because the normal buyers of those, hedge funds, institutions, people needing to hedge themselves, that sort of thing. I think they believe this transitory stuff. And you can see it in the bond market. Why is the yield on the 10-year note only 1.35% when inflation's 5.4%? Because somehow regular bond investors are willing to say, okay, I'll lose 4% this year, but I think inflation's going back under 1% next year. And then, so my 1.4% treasury for the remaining 9 looks okay. And so I think everybody's bought this transitory thing. And that's what the problem is. And so we'll just see if it is. On CNBC this morning, Elijah, Rick Santelli tried to say, well, transitory just means it's going to stop going up. Nobody thinks it's going back to 1%. Well, it's not what Powell has sold us all along. So we'll see. The moment of truth is coming.
We just saw the July CPI numbers, the official inflation rate at 5.4%. Your perspective, can we get an update on what you see for inflation going forward? I know you've talked about stagflation, that's really where you see us heading. With this new CPI number, does that change anything for you?
No, some people thought, oh, it's going to go even higher. Again, there's so many things in the CPI, and it's such a miscalculated inflation measure anyway, that even just staying at 5.4, again, my goodness, you go back to 2018 or 2012 or, any of these times when the Fed was so actively fighting deflation and everybody thought we'd never get over 2%. Even just a year ago, Powell was talking about deflation at his Jackson Hole speech in August of last year, was talking about deflation and deflationary expectations and all these worries. And now here we are at 5.4. Even if it normalizes, is that the right term? Stabilizes above 3, above 4. I mean, historically, that's a massive rate of inflation. Rule of 72, the cost of everything will double in about whatever that is, 15, 16 years. And that's not something that anybody should be excited about. So is it going to pull back? Yeah, I don't know. Maybe it'll stabilize in this region. But I think we're now in a period of stagflation, more stagnant economic growth, and inflation. And there's a couple ways we quantify that, Elijah. One, when we talk about economic growth, we talk about GDP, right? Well, when you get the numbers every quarter, those are inflation adjusted numbers too, which is all part of why inflation is measured in a way that underestimates it, so that the economy, back in the day could grow 4%, but inflation was 1, and they could say, look, real GDP is +3. Well, now if inflation's 5 and GDP is, the economy grows 5, well, your real growth is 0. And so there's your stagnant part of the inflation. And then in terms of inflation, why it continues, why it will persist, is that in economics class in college, anybody ever took one, just your basic macroeconomics, you were taught there are normally 2 drivers of inflation. One is called cost push, and the other one is demand pull. And we've got both. So what are those? Well, cost push is where input costs push prices higher, meaning that if you manufacture something and the input cost, be it copper or aluminum or energy to run your plant or wood or whatever, if those costs are going higher to make your stuff, you either have to pass that along to the buyer, the consumer, or your margins get squeezed, you go out of business. So your input costs push in prices higher, that's inflation, that's currently what we have. But you also have demand pull, where there's too much cash chasing too few goods. And you look at the current employment world where there's all these job openings and not anybody looking for them, and still all these people that are, I guess, more happy to take a government check than go back to work. It's more profitable, whatever the reasons are. One of the ways that employers can attract workers is to pay higher wages. Well, again, that just increases, besides all the stuff the Fed's doing. That just increases the amount of dollars chasing goods. So you got both inflation things, and that's why this transitory stuff I've just never bought. I just think that's job owning by the Fed, and to try to, like a short-term band-aid, to continue demand for treasuries so that rates stay low. Like I said, the moment of truth will be coming for that, and probably not that far away.
I think that's so key with respect to the kind of inflation we're going to see. It's kind of both cost push and demand pull is what we're going to see, which seems like inflation will just continue to be very high, in your opinion.
Right, exactly. And I don't know, maybe it's not going to ever be reported by the CPI at 10% because, again, I don't want to go off on a wild tangent about the CPI, but that was changed in 1992 by Alan Greenspan, how we measure inflation. So that primarily at that time, to control the cost of living adjustments for an aging baby boomer retirement in Social Security. But then, like I said, you put it all back together with all the other things about measuring GDP or understating inflation so that you can sell bonds at a very low interest rate. Again, regardless of how you measure it, I just can't see it going ever back to 1 or 2%, absent, some total, COVID-related collapse again or something. Which, who knows? if that's possible or, even likely. So if inflation stays up, eventually there will become a moment of reckoning. And I think the way I've described it for people on my site is Hemingway's old adage about, how'd you go bankrupt? Well, slowly and then all at once. And I think the recognition in the precious metals, especially after what we've dealt with these last 12 months, the recognition that inflation is not transitory and that sharply negative real interest rates are here to stay, I think that recognition comes slowly and all at once. And, it was just a year ago. I mean, gold was 1670 in early June of last year when the employment report was released on June the 4th or 5th of last year. By August the 5th, it was 2080. That was 25% in, like 2 months because, everybody crowded in at once. So, certainly not without precedent for, that slowly and all at once to happen. And I still suspect that's coming regardless of what we've dealt with so far this year.
This idea that transitory inflation, it's just going to be transitory. You mentioned how this idea that inflation is just going to be transitory is impacting the bond market and keeping rates low. When we do see that time of reckoning, how do you see that impacting the bond market and also precious metals?
Well, I've stated forever, back to when I started TF Metals Report 10, 12 years ago, the Fed cannot allow higher interest rates. I mean, they just simply can't. I mean, they tried to manage that a little bit in the period of 14 to 18. Remember, they were going to try to normalize their balance sheet, and they worked off, $700 billion over like 5 years. Then all of a sudden, everything seized up, and the stock market crashed in late 2018 as the 10-year note got to 3%. And it was like, oh, God, we got to reverse that. And they immediately reversed that, put that $700 billion back on in like 5 months in 2019. And again, why can't they allow higher interest rates? Well, I mean, it's as simple as looking at the interest on the accumulated debt. I mean, we're currently paying, the line item is about $450 billion a year on 30 trillion. That's 1.5%. Go to 3%, that's $900 billion a year. Now, of course, we're living in the world of magic money tree. So I guess you just borrow more and print more and pay the interest. But they really cannot, just on that simple level, afford higher interest. But then you start thinking about all the junk bonds that people are buying that would collapse in price and cause problems, in high yield funds. And you think about corporate bonds that would be unable to be, bought. No, the companies can't afford to pay 5%, and start buying back their stock like they are now, when they'd much prefer 1%. You think about municipal debt, state debt, personal debt, credit card debt, mortgage rates, all that stuff. So if the Fed tries to step away, if the Fed tries to taper, go back to, we're just going to be right back in that spot we were in 2018, and then here they'll have to come again. And so I don't think they will ever allow, maybe somehow there'll just be a buyer's strike and rates will spike, but I don't think they'll ever allow that to happen. There's too much on the line. And so therefore, once that realization sinks in again, as it did last year at this time, that's when the metals finally rush to catch up.
And then your perspective also on platinum, because there are very bullish fundamentals for platinum as well as gold and silver, but it's not a monetary metal. We have seen a pullback, but now we're seeing quite a bit of a bounce now. Your perspective on platinum going forward?
Yeah, it's funny you ask. I just yesterday, I was talking to a technical analyst by the name of Christopher Mullen, and platinum came up. And, on the short-term chart, it looks lousy, just like gold and silver do. I mean, it's below its 200-day moving average and all that kind of stuff. But what has happened to it is not atypical. I mean, it put in what looked like a bear market low, as did many commodities last year when everything broke down in the first quarter of 2020. And then it moved up solidly. It got to about $1,300 an ounce. Now it's back to 1,000 or so. That is, I hate to call it a correction because that makes it seem like 1,300 was too high. So I never like to use that term. That's a normal pullback within a bull market, where you move up and then the buyers run out of steam for a while and you pull back and people sell into it and you make a low and then you restart again. Look, if you believe the commodity story, and I do, I think on any historical measure, commodities, whether it's gold and silver, but copper, platinum, you go down the list, If you believe that we're in a commodity bull market, then platinum's just like anything else. And so, yeah, $1,000 an ounce looks pretty good.
I think that's so key. Again, I mean, we talk about this so much on the channel that, the day-to-day price action might be important for traders, but really if you believe the fundamental story, that's what's important. I bought some platinum back at, 1,100, and I'm not too concerned. I think it's going higher. That you can't give financial advice, but that's my conviction. So I don't worry about these kinds of pullbacks. But your perspective on that?
Elijah, no, I agree with you. And I try to do that too. Man, I do this every single freaking day for the last 12 years. People used to look forward to my daily podcast, on down days, because, I'd be fired, brimstone and rage, and railing against the banks and the like. But, then I figured out, well, that's not doing me any good. So I'm comfortable with the math. At TF Metals report, we talk about the end of the great Keynesian experiment. I mean, none of what's happened in the last 6 months or 12 months has changed any of that. Okay, it's a market perception of the value of gold derivatives that trade on the COMEX. Okay, maybe that's been challenging for the last 12 months, but I can assure you, though the dollar price of my gold and silver is down, the value of it has only increased every single day in the last 12 months. And to that one last thing I was thinking about, you were talking about, try not to get caught up in the day-to-day. I saw a chart about 3 weeks ago on Twitter, and then another guy sent me his own version of the chart last night. And I used it on my morning update today. And it's just simply a long-term chart that goes back like 50 years, plotting the COMEX gold price with the M2 money supply, which I'm not even sure we print anymore. And the Fed is trying to hide as much of that data as they can. But if you plot the two together, again, here's another really tight long-term correlation. Gold kind of got away and above the M2 money growth line in 2011, and then pulled back down and below in 14 and 15, and then moved to catch up last year. And now it's lagging again. M2, if you plot the two together, would see gold should be like 2,000 or 2,100. If the Fed continues to add money to the money supply, cash to the money supply, I should say, or cash to the cash supply, at the rate that they're currently doing it, then gold eventually should rush to catch up. And by 2 years from now, that would make a fair value, if you will, of about $2,500 or $2,600. So if that's the case, okay, yeah, that's only 525% above where we were last year at this time. But I don't think most people that are invested in gold would really mind, especially if you're in the mining shares. And that's just a basic metric, like measuring against real interest rates. So you never know. Maybe money supply will collapse. Maybe that will remain uncorrelated as it's been for the last several months. But, you just think of long-term things like that. You sleep a little better at night.
And kind of looking at what the Fed is going to do in the future, the next big news is going to be from Jackson Hole. Powell's going to be speaking there. What are you expecting from Jackson Hole?
Well, gold has bounced back this week after what was obviously a deliberate raid back on Sunday night. And I saw some people try to say, well, that's just a brokerage house blowing out somebody on margin at 6:45 Eastern on a Sunday night. No, it doesn't work that way. Okay. And so we recovered a lot of those losses. And as we record, we're about 1751, which means we're only down $12 on the week. So on a short-term standpoint, if the PPI on Thursday or something happens on Friday, we somehow turn positive on the week, that's going to get a lot of technicians and regular investors excited. They're going, okay, well, that was a washout low. Look at that. That's a big reversal candle. Everything went, wow, this is great. So we'll watch that into the end of the week. But I still think we'll probably remain pressured at least until Jackson Hole, because that's hanging out there. There's so much now expectation, especially after what Vice Chair Clarita said last week, that Powell's going to announce some kind of tapering plan at his Jackson Hole speech, which I think is 2 weeks from Friday. I think that's on the 27th, either 26th or 27th. So I would imagine we stay under some kind of, we don't really bounce back too hard until then. Then the dollar will probably keep going up too, which will keep a lid on things. Dollar's got a lot of resistance at 93.40. It's about 92.90 now. So maybe the dollar peaks out sometime in the next 2 weeks. Gold kind of stabilizes at, where it is here. And then this whole Jackson Hole thing, whatever he's going to say, which leads us into the September FOMC, maybe in the end that becomes kind of a sell the rumor, buy the news. They're like, oh, okay, well, maybe, they really are going to go really, really slow with this taper thing, and, and we'll see. And so gold kind of rallies after that, and the dollar, is more of a buy the rally, sell the news. So maybe by the end of the month and into September, the last third begins to treat us a little bit better. But for now, it'll be interesting to see as we go through the remainder of this week if we can somehow recapture all those gains or all the losses that were imposed upon us Sunday night.
All right. Well, Craig Hemke, thank you so much for your insights today. Before we let you go, if people are interested in learning more about your work, I know you have your banner right behind you. So if you can tell us about that.
12 years, brother. TF Metals Report. The site is a community of precious metals. And I do my stuff every day, a podcast and a post in the morning and all that kind of stuff. And we talk about all the daily. But really, it's a community of people that, we're all in the same boat. So it's only $15 a month. And for a lot of people, that have been trying to keep their sanity for the last 12 months or 12 years, they think it's a lifeboat. So I encourage everybody to check it out. You can just go month by month if you want. And, if you don't like it, you don't have to stick around. But I think there's pretty good value in 50 cents a day. Again, tfmetalsreport.com.
Fantastic. Craig Hemke, once again, thank you so much for your time, and God bless.
Always great to see you, Elijah. God bless you too, brother.
This week's specials with Miles Franklin Precious Metal Investments. 1 ounce 2021 silver Britannias for only $3.75 over spot. 2021 silver Austrian Philharmonics for only $3.95 over spot. And 2021 silver Australian Kangaroos for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.